In this video, I aim to elaborate on 3 winning strategies specifically designed for range-bound markets.
Nothing is more frustrating than a trade's stop-loss being hit precisely at a peak or bottom, only for the price to then reverse and move in the direction you initially anticipated.
This strategy is based on the observation that the resistance and support levels of a double top or double bottom pattern can greatly influence price movements even after being breached. In fact, the magnetic pull of these levels often draws price back once the stop losses beyond these thresholds are triggered.
Bearing all these factors in mind, let's explore how to capitalize on this strategy during a bull market.
Firstly, identify an ascending trend where consecutive higher highs and higher lows can be easily detected. Next, you need a significant pullback from that trend. Ensure this pullback retraces at least 1/3 of the previous trend. To determine this, you can employ the Fibonacci retracement tool and look for any pullback that is as deep as or exceeds the 0.382 level.
Afterward, measure the pullback with the Fibonacci retracement tool and manually add 2 extra levels, 1.618 and 2.0.
Please keep in mind that these numbers were not chosen randomly. These figures represent some of the most significant Fibonacci levels, which are derived from the Fibonacci sequence. Traders commonly use these levels to identify optimal entry and exit points.
These levels will be used as the entry point for the second half of the trade and to set the stop losses for both trades, respectively. Then, as the price ascends to its previous peak, consider entering half of your trade and placing your stop loss at the 2 level. For take profit, aim for the 0.382 level. If the price moves against your trade, consider entering the second half of your trade at the 1.618 level and then setting your stop loss at the 2 level. At this stage, consider choosing the entry point of the first half of your trade as the take profit for the second half. If the price retraces back to this level and your second trade becomes profitable, adjust the stop loss of your first trade to the break-even point of both trades or above a minor swing. Finally, wait for the price to reach the take profit target for the first half of your trade.
Now let's quickly look at how this reversal strategy works in a bear market to capture buying opportunities.
First of all, identify a descending trend where consecutive lower highs and lower lows can be easily detected.
Next, you need a significant pullback from that trend. Ensure this pullback retraces at least 1/3 of the previous trend. Afterward, measure the pullback with the Fibonacci retracement tool. Then, as the price drops to its previous bottom, consider entering half of your trade and placing your stop loss at the 2 level. For take profit, aim for the 0.382 level. If the price moves against your trade, consider entering the second half of your trade at the 1.618 level and then setting your stop loss at the 2 level. Now consider choosing the entry point of the first half of your trade as the take profit for the second half. If the price retraces back to this level and your second trade becomes profitable, adjust the stop loss of your first trade to the break-even point of both trades or below a minor swing.
Finally, wait for the price to reach the take profit target for the first half of your trade.
If you pay close attention, you will realize that this strategy is most effective in range-bound markets, where you can speculate on the potential boundaries of a trading range.
On the other hand, the greatest risk to this strategy arises when you opt to employ it in a market that is trending strongly in one direction. That's where your ability to distinguish between ranging and trending markets becomes invaluable, because without understanding the market's overall structure, any strategy you choose is likely to fail. I've created a video discussing the different market cycles in detail, as well as how to anticipate a trading range in advance. I highly recommend watching this video to complement your understanding of this strategy. You might remember that when I first introduced this strategy, I mentioned that it could offer exceptional trading opportunities with excellent reward-to-risk ratios, particularly if it signals a major reversal. For instance, in both scenarios, you could identify clear reversal patterns that might signal such significant impending reversals. In the first case, I draw your attention to the formation of a 3-push pattern at the upper threshold of the trading range, which is a clear sign of a major reversal. Alternatively, In the second case, the formation of a reverse head and shoulders pattern could provide us with the final signal to stay in the trade for longer. In both situations, rather than sticking to the initial take-profit levels, aiming for more extended targets, such as a major swing high or low, or even the opposite side of the trading range as the final profit target, could significantly boost our trade's potential gains. The slingshot pattern is another reversal trading strategy based on false breakouts, typically employed on 1-hour charts. This method is especially reliable in the Forex market. To seize buying opportunities with this strategy, monitor for a break of the support level drawn from the low of a major swing low. Following the break, the price should not linger below this support level for an extended period, but should quickly reverse and rise back above it. To determine the entry point for a buy stop order in this strategy, you can simply add 10 pips to the support line, and as for the stop loss, you can place it just under the last swing low. However, for more sophisticated entry and stop levels with a possibly better reward-to-risk ratio, consider using the average true range, ATR, a volatility indicator in technical analysis that is particularly effective for calculating precise entry and stop points. For the entry point, figure out the ATR value of the breakout candle and add 10% of that figure to the support level. As for the stop loss, subtract the same amount from the support level. For taking profit, select the nearest resistance level, which is drawn from the high of the last major swing high. The third strategy I will discuss harnesses the potential of trading range thresholds and merges it with the reversal power found in supply or demand zones. To seize buying opportunities, you should monitor a trading range formation where the price has touched both its upper and lower boundaries at least twice. You should then search for a well-defined demand zone, characterized by a relatively small candle with ideally short wicks, followed by 1 to 3 sizable bullish candles. When these explosive moves to the upside gradually lose their momentum and the price retraces to the demand zone, you can place a buy limit order around the middle of that region. To pinpoint the precise location for the stop loss, where it is protected from potential stop hunting by institutional players, employ the ATR indicator, as in the previous strategy, and subtract 10% of the ATR value from the lowest point of the demand zone. As for realizing profits, you should target the opposite side of the trading range, which is composed of 1 or more swing highs. To maximize the profit potential of this strategy, beyond the establishment of an ideal demand zone, you should also observe how the price retraces to this area. A compression pattern pullback to the zone is ideal. Such a pattern increases confidence in the potential for a reversal at that level. The opposite applies to a bearish scenario, which involves a supply zone rather than a demand area. If you're keen to dive deeper into more hands-on strategies that leverage the intricacies of price action, just give me a shout in the comments. Thanks for tuning in.